November 11th, 2024. Today was a trending trading range day. Didn't really trade exactly like normal, your most typical trending trading range day, but it ended up looking pretty much, like a textbook trending trading range day. We got a triangle on the open and then a breakout in the middle of the day. And then a second trading range, and the high of the second trading range was essentially around the low of the prior trading range. A lot of times when you get a triangle on the open, like we did here, we'll try to get some sort of measured move. So you have to mentally, when you recognize that the market's in a triangle, you should mentally think of the profit target as the measured move of the triangle, which was down here. Obviously, we didn't quite get there, but we got within about a point of it, so pretty close. And the market was obviously paying attention to it, and we had a pretty strong reversal up from that area. Bar one, a bear bar closing near its low. The past couple days have been bull trend days, so you have to be assuming at this point that we're probably going to convert into some sort of trading range. You can see we had 3 consecutive bull trend days. So although we're getting a gap up, are the odds that increase that we're going to get a big bull trend day today? Not really. I don't think it's all that likely. Also, the gap up was essentially onto the bull trend line, so we gapped up into that area, and that's probably one of the reasons why we got a bear bar closing near its low on bar one. So bar one, possible high of a trading range. Bears would argue that we got a trend line break here from the bull trend, and then this is a higher high major trend reversal, which is a valid thing to think. The thing is, if you're going to get a higher high major trend reversal, what usually has to happen first? You usually have to get a lower high. So although you do get a higher high major trend reversal, you have to be expecting a lower high, which we do form over here. So bar one, a bear bar closing near its low. An inside bar, bar two. Bulls, they have a big gap up on the open and an inside bar on bar two. So they're hoping that it's the low of the day and that would get a swing up. But reality is, oops, sorry about that. Reality is we're probably not going to. We're probably going to go sideways. Outside down, bar three, a large tail on the top. We went a little bit further down to the outside than we do up. So, or sorry, a little bit further up, I believe, than down. 2.75 points and 2.25 points. In general, when the market does that, it's probably a little bit better to sell above the bar than to sell below the bar. However, it's still an outside down bar, and the context of a lower high major trend reversal is pretty strong. So I think it's okay to take the short below bar three for a possible swing down and a possible high of the day. Bar four, follow through for the bears, but a large tail on the bottom. A lot of the bears who sold below three scalped out during four, and that's what's causing the big tail. Five, an inside bar, a low one short, follow through. But again, if you sold below three, you're now 2 bars later and you have maybe 2 ticks of profit. So is it really worth it to sell below five? No, probably not. There's probably buyers below five somewhere willing to be scaling in lower. Six, another tail. So 4, 5, 6. Again, if you sold below three, which was a reasonable thing to do, look at your follow through so far 4, 5, and 6. Really not all that great. You have huge tails on all three of those bars. So while it is okay to be short, if you're going to stay short through a pullback, you have to just kind of keep your stop above three and be at peace with the fact that it might get hit. Seven, an inside bar, another low one short for the bears. This was a bear bar closing near its low. A lot of times, I'm a little bit mentally flawed on the exact logic. It's a little bit of a climax almost on bar seven because 4, 5, and 6 large tails. So when you finally do get the bear bar closing near its low, a lot of bears use it more for profit taking than anything else. And we're right at the moving average. So probably some buyers below willing to scale in lower. Bulls who bought the bar too low and were willing to scale in during 3, 4, 5, 6, whatever, haven't been able to get out yet. So probably there's going to be sellers if we get back to the bar too low, since the bulls who bought too low are willing to scale in. 8, bear bar, but a large tail on the top, or sorry, a large tail on the bottom. You can see bulls were willing to buy the moving average. So we have, yes, a 6-bar bear micro channel, but buyers at the moving average. Probably sellers above 8, scaling in higher. During 9, you can see sellers above 8, probably scaling in higher. And again, probably not necessarily sellers immediately above 8. Why? Because we're pretty low in what's probably a leg in a trading range. If you look at 3 through 8, yes, it's good for the bears, but does it make your brain think bear trend, or does it make your brain think a little bit more, probably a leg in a trading range? It probably makes you think a little bit more that it's a leg in a trading range. So although you can sell the close of 8, you have to be willing to sell the close of 8 or sell above 8. You have to be willing to sit through a pretty deep pullback. So sellers above during 9. An inside bar, a low one short during 10, not that great. The bears are hoping spike, pull back on 9, and then a bear channel is going to start here. However, it looks to me more like the bottom of the trading range. 11, a bull bar closing near its high. We haven't gone below the moving average yet today, so I think that's rather disappointing for the bulls. 12, a bear bar closing somewhat near its low, but a tail on the top and a tail on the bottom. You can see right on the moving average, right? So look, 8, 9, 10, 11, and 12, all unable to close below the moving average. I think it's important that 8 was not able to, and that we bounced on 9, and then again failed on 10. But look at 12. 12 was a pretty clear attempt for the bears to get the bar to close below the moving average for the first time today, and they weren't able to. So bears buying back shorts, and that's what's causing 13, a bull bar. A tail on the top of 13, I think the buy is a high 2 on bar 11 if you wanted to take it, but it's really not that great. It's possibly low in a trading range, so maybe okay for a scalp, especially if you're willing to scale in. But 11 is really not the most excellent trade. It's a pretty big bar, and the risk is relatively decent. So if you're risking 5 points, where's 2 to 1? 2 to 1 is up here. So while it is, probably an okay swing trade, it's just not necessarily a high probability trade and not, the best trade you could take. Some traders bought the close of 12 instead. Like I said, 13 big bull bar. We have a pullback on 13 and then a bull surprise on 14. And this is a really easy trade for beginners to get trapped into because you see 13 and 14 and you think, oh my God, we're going way higher. This is going to be a huge bull trend. But a couple of things to keep in mind is one, we're obeying a possible bull channel line. So we might be in the beginnings of a bull channel. So the high of the day might be a potential high. That's not really that important, but the really important stuff is that we're around the open of the day on a probable trading range day. And what did I say at the beginning of the day? We had 3 consecutive bull trend days. What are the odds that this is going to turn into another bull trend day? Not that high. And if it is going to turn into another bull trend day, you should probably just wait for more follow through. The market can very easily trap traders after 2 bars in one direction. So 13, 14, huge bull bars, yes. But the market, will often trap traders after 2 consecutive bars. After 4 or 5 consecutive bars, much less likely. So less likely that something like 35, again, the context is okay for 35, not perfect, but it's much less likely that something like that is going to be a trap than it is that something like this is going to be a trap. This is a reasonable probability of being a trap. And when you get a second leg trap, rather than buying above bar 14, it's probably better to buy the low of bar 14. Or what you can do instead of either one of those things, because you shouldn't be trading on limit orders if you're a new trader, is you should be waiting to see if 15 is another good looking bull bar. And if we get a breakout above the high of the day. And if we get a breakout above the high of the day with follow through, just think about it this way. I know it's easy to look at and think to yourself, well, if we get, 15's bull bar and 16's follow through, then we're going to be so deep into the bull trend. But you're not. The reality is, if you're buying in here, you're trying to catch the spike. Stop trying to catch the spike. Stop doing it. Instead, wait for the spike to finish and then trade the channel, because it's much higher probability when you're buying the top of the spike that you're gonna sit through a pullback. You are, but if you're ever going to be a profitable trader, you're going to have to learn how to sit through pullbacks. It's part of the business. You have to know how to sit through a pullback. So you might as well start practicing. But traders buying the closes up here are willing to sit through a pullback because they know the channel is high probability. It's not high probability yet on bar 14 and your risk is massive. So it's really not worth buying. Outside down bar 15, do you sell bar 15? I probably would not. 13 and 14, although not great by the close, is big enough that traders are going to buy the low and expect the second leg up. 16, an inside bar. It's a smaller bar, a high one for the bulls. You could probably take it on a stop order and just take a chance that 11's the low of the day. We haven't gone below the moving average yet today. So if you're buying, you're kind of taking a chance. We're going to break out to the upside. We're going to break above the bar 14 close. 17, another bull bar closing on its high. 16 and 17 closing on their highs. 14, 16, and 17 all closing on their highs. Good for the bulls. Massive tail on 17. So you can see that 17 sells off to around the 15 close. Bears buy back shorts, and then 17 closes on its high. However, the tail on 17 shows a lot of overlap with 16, so really not as good as it could be. 18, a bull bar rally up to around bar 14 close, and the bulls who bought the close of 14 sell out of their longs, causing the tail on 18. 19, doji bar. So what does it look like to you? It looks like we're forming lower highs and potentially higher lows. Again, here, this is all you can see so far, but obviously it ended up extending up to here. 20, a big tail on the bottom. Something to keep in mind whenever the market is in a tight trading range for the first, I don't know, hour or two, the market usually starts to try to break out around bar 30. 21, an inside bar, a low one short for the bears, but really not that strong. We're probably going to go below the moving average here, but there's going to be buyers somewhere below, scaling in lower. 22, a bear bar, expecting sellers above, scaling in higher. And then 23, you can see sellers above 22 during 23. Big tail on the top and tail on the bottom. 24, follow through. So to me, this looks like a second leg down. Looks like the first leg was to bar 22 and then pull back above 22 and then 23, 24, second leg down. 25, a bull bar closing near its high, or sorry, not quite near its high. It's a high two for the bulls. The high one was bar 22, but not really great to buy above 25. I'd probably rather wait. 26, follow through for the bulls. So 25, 26, consecutive bull bars closing near their highs, or reasonably near their highs, but really, again, not as good as it could be. It just looks like the middle of a trading range to me. Buyers below 26, though. However, if you're going to, I hesitate to even say if you're going to trade on limit orders because don't do it. You shouldn't. But if you are going to trade on limit orders, you should trade in the always in direction. So it's not that clearly always in long on 26. So it's not as great to be buying below 26 versus something, excuse me, versus something like 14. And the reason I say don't trade on limit orders is the same reason Al always says don't trade on limit orders if you're starting out. The same reason Brad says don't trade on limit orders if you're starting out. It's because you're trying to learn how to run before you learn how to walk. If you're trying to trade limit orders before you learn how to trade stop orders properly, everyone looks at limit order traders. You look at Al and you see that he barely loses trades, and he barely loses trades. He's really quick, and he doesn't really lose much money. He never has to risk that much, and everyone thinks, well, I want to do that. Well, that's not how it starts out. Again, you don't get to have the prize before you put in the work. So you should be trading on stop orders and learning how to sit through pullbacks. And just trade small and do that. 28, a doji bar. So we probably should get back to the bar 26 close at some point. Inside bar 29, probably sellers above, scaling and higher. 30, a bull bar, but rally to around the bar 26 close. Traders who bought for any reason, selling out of their longs around the close of 26 during 30. 31, a bear bar, closing reasonably near its low, but not really worth shorting. It looks like we're at the apex of a triangle, so it's it's in general pretty 50-50. So traders usually wait for a breakout. However, the fact that we've been in a bull trend for the past couple of days, to me, tells me that it's probably more 40% chance that we break out to the upside and 60% chance that we break out to the downside, simply because we've been in such a bullish environment for so long that the bulls are probably exhausted. Now, does this mean we're going to get a major reversal down? No, it just means we're probably going to go down, like this for like a day or so. So it doesn't necessarily mean we're going to get a giant reversal. Again, it looks like a big bear trend, but on a daily chart, it was basically just a tiny little pullback, right? You can see that's all it is. And it's smaller on the Globex chart, which I'll show you in a little bit. So I was expecting a little bit to the downside today. $32, another bear bar, but a tail on the bottom. So again, this is not a convincing breakout yet. To me, it's still the apex of a triangle. 33, 3 straight bear bars. Good for the bears, probably going at least a little bit lower. 34, surprise bar down. Good for the bears, probably going at least a little bit lower. This after 34 is clearly a breakout attempt to get to a new low and break out of the triangle, potentially get a measured move down. 35, another follow through bar. You can see on 34, we have a huge tail. Why do we have a huge tail? Because on 35, we have a huge tail. Why do we have a huge tail? Because on 34 is potentially a bear trap. So you could sell the close of 34, but it's probably better to wait for one more bar to see if the bears do end up getting the one more bar to confirm the breakout. To me, 34 is a breakout attempt of the triangle, and to me, 35 is the follow through. So that's the sell. It's 35, a little bit more than 34. Is this like the world's best sell? No, I mean, there's a large tail. It's overlapping 33. We're probably going to pull back, and it's overall a trading range where you have one bear bar closing near its low. Additionally, you're selling, kind of on a bear channel line, but you don't care about that as much if you're looking at, I think. So I did sell the close of 30. This is the only thing I did today. I sold the close of 35, went for a measured move, exited down here, and that was all I did today. Anyways, like I was saying, you don't care as much about this because the triangle is the bigger picture over 30 or 40 bars. So I thought the triangle was more important, and I thought the daily range could double. So I thought both of those things were a little bit more important. However, I was ready to be proven wrong. So if 37 was a good-looking bull bar closing near its high, I might have exited. Same thing with 38. However, Sorry, I meant 36, not 37. So if 36 or 37 were good looking bull bars, I might have exited. However, 37 or 36 is a small doji bar. So you'd have to imagine there's probably sellers above scaling and higher. The sell off from 31 through 35, you know there's going to be sellers above scaling and higher during 36. 37, a bull bar, a large tail or a tail on the top, probably not going that much higher. 38, a bear bar closing near its low, triggering the low one sell below 37. A good looking bear bar closing near its low. 39, follow through for the bears. Good for the bears, probably going at least a little bit lower. A tail on the top and a tail on the bottom. 40, a bear bar closing near its low. So 38, 39, 40. Three straight bear closes, yes, but big, small, big. Big on 38, small on 39, big on 40. So probably all that really means is we might pull back a little bit before we continue down. However, it's not necessarily a reason to exit. 41, a bull bar, a large tail on the top. At a certain point, 41 was a really scary bar for the Bears, but they ended up selling it off. So there was really no reason to exit on the close of 41. And then you get a shaved bar, pretty much a perfect looking bar for the Bears on 42. 41 was the Bulls' attempt at a midday reversal, and it's failing, so it looks like we might get the measured move down. 43, big bear bar, but a large tail on the bottom. Sell climax, again, it's parabolic if you look. You could argue this is the initial trend line, something like that, and then we have a steeper one here, and then it gets even steeper way down here. So 44, a bull bar, but a large tail on the bottom and a small tail on the top. Do you buy above 44? No. I mean, you probably don't even buy below it. Because the reality is, though, there's probably buyers below, scaling and lower, but it's not worth doing anything. You can see there were buyers below on 45. Sellers above 45 during 46, a bear bar closing near its low. Are you selling below 46? Maybe for a scalp, but I'd probably just rather wait. 47, consecutive bear bars, 46, 47. But again, large tails on 47, not really that great. And then a bull surprise, 48, bull bar closing near its high. I think 48 is one of those times where a singular bar flips the context to always and long. Yes, it was possible we were going to get a bear trend for the rest of the day from the triangle, but it wasn't all that likely considering how steep the bear trend was. It was getting steeper and steeper. Usually when a trend gets more and more parabolic, it's pretty unusual for it to get a crazy large sell-off. This is pretty rare, and when it does happen, there are obviously massive sell-offs, but they're few and far between, so it's better not to bet on that. 48, in my opinion, flips the market to always and long because we're probably going to be sideways to up for the remainder of the day. However, 48, big bar, big risks. Some traders choose not to buy 48. Instead, they buy the 47 high during 48. Why the 47 high? Because the bears who sold above 47 during bear bar, it's probably reasonable to sell above. They tried to scale in on 48 and they got trapped. So they don't like how 48 looked, and they're going to use 49 to buy back their shorts as it trades back to the bar 48 high or 47 high. 49, an inside bar, a high one for the bulls, probably sellers above scaling and higher. Or actually, no, not probably sellers above. Sorry, I'm just used to saying that. But high one, but bull surprise 48 is going to get a second leg, so I would not sell above 49. Maybe sellers above scaling in way higher, but we're probably going at least a little bit higher. 50, a bull bar, but a tail on the top. Again, we're probably going at least a little bit higher. 51, consecutive bull bars. 50, 51, large tails. Expecting at least a little bit more at the upside. 52, another bull bar, but a tail on the top. 53, another bull bar. Again, tails on the top, but we're still rallying, so it's okay to just hold long at this point. 54, a bear bar trading below 53. The reality is the bulls who buy below 53 and are willing to scale in are going to make money. 55, consecutive bear bars, probably sellers above. And, basically the bulls tried to get trend resumption for the rest of the day. I could go through, if you guys have questions on anything that happened in here, why you shouldn't buy any of these, you can leave it in the comments and I'll answer. But the reality is, you start to go sideways here, you should only mostly be looking for trend resumption. And the way you could argue trend resumption down or trend resumption up, but the way you quantify actual trend resumption is a breakout above or a breakout below the range. Once we get this kind of, high two, essentially 57, and it trades above, it's pretty clear somewhere in here is the bottom of the range and somewhere up here is the top of the range. So you're going to need 2 or 3 bull bars closing near their highs in order for traders to look to buy. And you're going to need a couple of bear bars closing near their lows in order for traders to look to sell. It's better not to buy, 64, 66, 68. I get that it looks tempting because you're thinking to yourself, well, if I buy 68 and we start to rally and we get to buy the close finish, I can make a lot of money. What am I saying? What are you trying to do? If you're taking these buys, think about what you're trying to do. You're trying to catch the spike. Stop trying to catch the spike. Let the spike happen and buy during the spike or as the spike, more difficult. But if you're dead set on trading limit orders, just let bull spikes happen and then buy the close of the first bear bar, or let a bear spike happen and then sell the close of the first bull bar, or sell the close of the second bear bar, whatever. Again, it's a more dangerous system, but it's probably okay to do. But I would just recommend, you see the stop order and take that. So stop trying to catch the spikes with bars like 68, etc., maybe 61. It's just not worth it. You're going to end up getting chewed up way too often. And it's probably much better to just wait and trade sell to close, buy to close markets, because the reality is what you're going to learn is you're going to make way more. You're not going to make big chunks is the thing. So if you're trying to take swing trades like buy the close 68 and you're trying to make 15 points, it's not going to be a thing if you're taking these buy the close, sell the close trades, but you're going to consistently make 5, 7, 8 points, whatever. You're going to consistently make smaller pieces rather than a bunch of little losses and every once in a while a big winner. It's going to be a lot easier mentally to do that. You can see we got a breakout attempt at the end on 78, but then it pulled back, and we're probably going to be back in this tight trading range. So the bulls are hoping trend line break, and we're going to get a pullback in some sort of higher low major trend reversal, maybe a lower low major trend reversal. We'll see. The daily chart. Delete this. The bear close. We have 4 or 5 straight bull bars. You can see the bodies are shrinking. So this is a sign of weakness. Big bull bar, and we're slowly shrinking. But if you think back to bull spikes and bull channels, while this is a bull spike and we're probably going to get a pullback, what's going to come after a bull channel? It's just too much for the bears to reliably get some sort of sell off here. Might we close the gap with this high, the 59.26 area? So might we close this gap, pull back into this area? It's possible that we do, but the reality is spike, pullback, bull channel for some sort of measured move. We do have a bear close, so that signifies the end of the bull spike. But 1, 2, 3, 4, 5 bar bull micro channel. The weekly chart, again, huge bull bar for the bulls on this. So you'll be interested to see the follow through. What's it not going to look like? It's probably not going to look like last week. It's probably going to be something disappointing. I think it's honestly important if the bulls can get a couple more bull closes in a row, then that increases the chances we go higher. But if this is a bear bar closing near its low, that would be pretty disappointing for the bulls. The monthly chart, again, climactic, yeah, parabolic, yeah, but it's also the S&P 500, so it kind of just does that. But I don't know. My gripe with this really is how far up we've gone. The market's always going to be in a bull trend, obviously, but it's already up, 25, 26% this year. And SPY, that's the SPY is the more accurate one. So the SPY is up 27.5% this year, and the average S&P return is 8 to 10%. I've been saying this. I know I'm going to be a broken record, but that's just a lot. And I do think we'll get back to 5,000 or on this price 500 at some point. Do I think it'll be this year? It will not be this year. Do I think it'll be next year? I don't know. Maybe, maybe not. But do I think we go to 7,000 before we go to 5,000? I wouldn't be so sure. But again, the infinite bull trend is hard to bet against, right? You're not going to be, if you scroll out, it's always been in a bull trend over time. Obviously, it's getting steeper and steeper and steeper, right? 2008 ended up being the same price as 1997, and I don't think we're ever going to see, I don't know if we'll ever see 400 again. That would be a bit surprising, but maybe we do. I don't know. Al says you see 150% correction in your lifetime, and you'll see a bunch of 20% corrections. So, if we go to 700 and then get that once in a lifetime 50% correction back down into this area, the 350 area, that would mean that this all is a leg in a trading range. But that's just I don't think that's going to happen. That's just a theoretical thing, the once in a lifetime thing. But again, better not to bet against the infinite bull trend. But my only real just gripe with it is how far up we've gone. So for good trades today. Sorry. You just get up the chart, turn off extended hours. You could sell below 3 for a possible high of the day. Probably better to wait. You could buy above 11, but I don't know. I probably wouldn't. Don't buy above 14. You need to wait for follow through. You could probably buy above 16, I think, but 17 risk is bigger, and the overlap with 16 is an issue. And then you can see traders selling out. So if you're buying, you need to be quick to get out and give up quickly when traders start giving up, like 19. And then 20, you can see traders are disappointed with 20. So 21, as we rallied back to the bar, 19 closed, they exited. I wouldn't really do anything else until, I sold the close of 35. You could have sold 38, made sense if you wanted to wait for the pullback. And then a bear bar closing near its low, you could have sold below 38 with less risk, putting a stop above 37, 39, maybe. No, I wouldn't sell the close of 39. You could sell the close of 40, you could sell 42, you could buy 48 and hold, and I wouldn't do anything in here. So if you're one of those people who's still watching the end, I appreciate you. And I would just really like to say, like, really, this week, next week, for the next year of your life, if your trading career, just focus on sitting through pullbacks. If you bought the close of this and you sat through all of this and you exited up here, you did a good thing today. And even if you take one trade a day, more isn't better. Better is better. So you don't need to take 10 trades a day to be a living as a trader, make a living as a trader. You really, if you take 1 to 2 good trades a day, that's plenty. I know it feels a little backwards and it's hard to sit through these kind of the kind of days where you're playing defense, but it's important to play defense. You have to sometimes when you're trading. Sometimes your setup just isn't there, and instead of just getting crushed on certain days, you'll end up doing pretty well. There's been plenty of times in my career where I would have, I don't know, bought this and then exited and bought and lost and sold for some reason and lost for some reason. But, days like today, it's just not really great for the way that I trade. I take one trade, I end up winning it, and that's plenty. So just try to keep that in mind. All right, that's the day.